Hey guys, so today, or yeah, this video, we'll be going over these things called confluences. So confluences are very important in trading as the way we use confluences is basically just to kind of confirm where where price wants to go. Um, and we just use confluences to, once we find out where we are predicting price wants to go, we just use confluences to make sure price is going to go in that area, and then we could start a trade. So let's first go over confluent or the whole idea of this confluences, right? So there's the fair value gap. So fair value gap. And there's another version. Oh shoot. Oops. There's another version of this called an inverse fair value gap, which I'll show in a minute. Then there's this thing called order blocks, um, equilibriums, something, however you spell that, um, and other stuff that I'll probably think of later. So let's first go over what is a fair value gap. So I'm just gonna use this example because I am a little lazy, and this is something that I was marking out this morning. Because I wanted to take a trade this morning, but I didn't because my confluences weren't fully hit. But I'll show you guys. So basically, this is a fair value gap. So what a fair value gap is it's essentially a space within three candlesticks, right? So as you can see here, like let's look at these three candlesticks, right? We see this one, and this one. Right, so if we were to mark out this area, this space with or this imbalance within the market, this is called, again, a fair value gap. So what a fair value gap is essentially you could think of it as like a magnet in the market to where price is gonna want to go off there and then push off of it. So what I mean by that is in this area, right, we have this fair value gap. So we've created this fair value gap. And then you could see that price actually comes up and fills out this fair value gap. You could see price hits it, price comes back into this fair value gap, and then we can see price go down. So that's essentially what a fair value gap is it's essentially a three candle imbalance within the market, and it's just a magnet of where price is going to want to go. So another example of a fair value gap would be right here. Let me just move this down really quick. So as you can see, right, we can see this fair value gap is created. Okay, so let's mark this out, fair value gap. Okay, so we can see that this fair value gap is created, right? So what does price do? Price comes back down, right? It's going down, and then it comes back up into our fair value gap. And then what does it do once it touches our fair value gap or fills out the imbalance within the market? It goes straight back down, as we can see here. So yes, price goes straight down. So that is a fair value gap, and this is actually a trade I took. When was this? Friday. I took this trade and I got some money off it. Um, but yeah, so that is what a fair value gap is. It's essentially a gap within three candles and it just shows that price is gonna go either down or up depending on either if it's bullish or bearish. Um, so that was a fair value gap, and I'll just draw it out one more time. Okay, so again, this took me a second, but again, if you missed, like, if you still don't understand what a fair value gap is, it's still just a gap within three candles, right? So we could see there's a fair value gap here because there is this gap. You could see from this wick to this wick, there is a gap in these three candlesticks. So all we have to do is we get our box tool. And if you don't know how to get a box tool, it's just this rectangle. I have mine favorited. That's why there's the stars here. But yeah, you can get all these stuff over here. So anyways, so yes, all we have to do is, let's make this a different color. Oh, that's not a good color. Okay. Oh, okay. So yes, all a fair value gap is, it's essentially a like a little imbalance within the market, and what will price do off of it? It will come back down into our fair value gap, fill it out, and then shoot back up. and that is a fair value gap. Oh, and then okay, and then again, if you didn't know, these fair value gaps work either if price is going up or down. So in this example, we have these bearish candlesticks, or basically price is red or it's going downwards. Um, but yeah, so we have these bearish candlesticks. So what is price going to do? It is going to come back up into our fair value gap, which we marked, and then it's going to push back down, which we saw earlier. Oops. So again, just to remember why we use fair value gaps, we just again want to know that where is price going to go, right? We could see here, we create this fair value gap right here, and then price comes down, gets into our fair value gap, and then pushes back down. Okay, so next thing I want to talk about is inverse fair value gaps. So there are two different types of fair value gaps. As I was saying, there is the fair value gap, which we just went over, and then the inverse fair value gap, or IFVG. So what is an inverse fair value gap? So we went over what a fair value gap was, and it's basically just an imbalance within the market, which kind of shows that price is going to come up to that fair value gap and then push either back up or down. Okay, so I'm being a little too lazy, and I don't feel like drawing more. So this is what an inverse. So an inverse fair value gap is basically the same as a fair value gap in the sense of how we mark it, right? So if we look at um, these three green candles right here, right? This one, and this one. So we could see that there's a gap, which our fair value gap is. So there's a gap between this candlestick or these three candlesticks. So how do we mark it? We just go within the gap that it it creates. Okay. Um, and then how do we recognize if this is an inverse fair value gap or a fair value gap? So what an inverse fair value gap is it's essentially a fair value gap that price creates, but instead of pushing back up as we saw earlier, price actually continues downwards, right? And what does this tell us? Okay, then price is most likely going to, once it closes underneath this fair value gap, then we know it's an inverse fair value gap. And what does price do after this inverse fair value gap? Then price goes straight downward, or well, it goes up and then down. So essentially, an inverse fair value gap is just a fair value gap that we create, but instead of bouncing off this fair value gap, we can see that price actually, um, instead of bouncing off, you can see price actually pushes underneath this fair value gap, which causes it to go lower. So how do we use fair value gaps? Again, like in this example, let me delete this right here. And this we'll go over later. So how do we use inverse fair value gaps? Well, just to confirm if price is going to go in either direction, right? So this, we have this fair value gap. Also, don't be worried about the size of a fair value gap. Like fair value gaps, it can really be like a really tiny gap or a really big gap. It doesn't matter, but price is still going to react the same way regardless of the size. Okay, so size doesn't matter, guys. Sorry. Anyways, so with this inverse fair value gap, or with this fair value gap, right? So we create this fair value gap right here, and look what does price do? Price comes back down into our fair value gap, and then instead of bouncing off of it like a regular fair value gap does, it actually closes way beneath our fair value gap, right? So what does that tell us? Price is most likely going to continue going downwards, right? And as you can see here, that is exactly what price does. And we could just find this everywhere, right? We can find this fair value gap right here. It's market inverse fair value gap. So we could see here, right? Price creates this fair value gap. So price creates a fair value gap. It comes back up. Well, it's supposed to say IFV, whatever. It comes back up, but instead of coming back down, it actually closes, right? We see this candle closure above this fair value gap, or inverse fair value gap, my bad. And then what does it do? It goes upwards. Okay, so the next confluence we have to go over is really important. These are called break of structures. So what does price do? Price can either go up like this and keep going up like this, or price can go downwards like that, right? So this is just, as you can see, price is going up. It's creating higher highs and higher lows, and then we could see price is going downwards. Price is creating lower lows and lower highs, right? So what is a breakup structure? So, oh, and then also price can consolidate. When price is consolidating, it's basically when it's going sideways, like this. That's what price consolidation is. So, what are breakup structures? So, breakup structures are when we are in a certain, like let's say we're in an uptrend, right? A breakup structure is when price closes beneath our recent low or high. Okay, like in this example, right? We could see that price goes up, 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 right? But then what does it do? It closes underneath this low, right? And you could see in these examples, price doesn't do that. Price goes here, creates this low, goes here, creates this low, but it's still higher than this one. But what is price doing right here? It creates a low that is underneath this previous low, right? So like if we were to think about it, we have this low, right? Let's say, like let's just forget about this. If price were to go down here, from here, right? From here, then this would be a breakup structure, right? So we can understand breakup structures as essentially what they sound like. It's when price breaks structure either in an uptrend, downtrend, consolidation, whatever, and we could see through this, right? So let me show you an example. Um, if we are in a downtrend, right? So let's say price is going down, and then boom, right? We could see that price goes down, creates a low, creates a lower low, creates a lower low, then price creates this high, a lower high, and then a lower high. But then what does price do? We have a break of structure right here, and we could see that price closes above this high. So why why are breakup structures important? We use breakup structures to understand, it's just another confluence, right? So right here, we could see right here, I don't like this color. Let me change this. Just change it to white. We could see price is in an uptrend, right? If we to draw this up, down, up, down, up, down, up, down, up, okay, right? But then what does price do? It goes all the way down, right? And what does this pattern look like? It's a break of structure, as we just went over. So again, right, and then to know if it is a break of structure, it's basically we have to make sure that the candle closes underneath our last low or high, depending if it's a downtrend or uptrend. But we could see here that this is a break of structure because what does price do? It closes underneath our recent low, and again, we have a break of structure. Okay, and then same goes if we are in a downtrend, right? You can see price is going down, down, up, down, but then what does price do? It comes back up and it breaks structure, right? And where does it break structure? It breaks structure above our last high. So our last high was right here. What does price do? We could see this candle closure above the high, or yeah, above the high. So what does that mean? Price is going to keep continuing that way, which it does. I don't know why I said it like that. Okay, so next thing or the last thing we'll be going over are order blocks. So you might be asking, what is an order block? So basically what an order block is, it's an area in market that has had a recent like reaction that once price hits that area, it's going to have the same reaction. Which I know it doesn't really make any sense right now, but just bear with me. So like if we take this example, right? First, what do we see here? We can see, let's change this color actually. I don't like this color. We can see liquidity, right? Liquidity. If you don't know what liquidity is, it's just highs and lows. So we could see we have our area of liquidity. So what does price do? We get a liquidity sweep. If you don't know what liquidity sweep is, just come and text me and I'll let you know what it is, or I'll make another video on it for people that don't know what it is. But we see price makes a liquidity sweep. It grabs this liquidity, fills out all these buy orders, and then it sweeps all the way down. Now, once price, so look, right here you can see this is our area of liquidity, right? And then price starts to go down around here. So we can mark it off with a box, right? And then, oh, that's, and then, right, we create this thing called an order block. So what does price do? Once it hits this area, what does it do? It goes down, right? And that it's basically like a fair, it's like another version of like a fair value gap. It's basically just price creating another zone to react off of, to hit and then keep going in the direction that it was planned on going, right? So this is what an order block is, and I'll show an example right now. All right, so coming back to our recent trade that I did, which there is a line that I deleted if you guys don't remember. Um, but here is our order block, right? And I'll show it to you guys right now. So essentially, an order block would be like first, let's identify what's going on, right? So we could assume that this is the high. Let's do this. Okay, so first we have our high, right? This is our London session high, okay? And I'll explain session highs and lows in a different video, which will probably be in the liquidity sweep video, so watch out for that one. But we have our London session high, right? So this is our point of liquidity, okay? So price breaks above liquidity, and then what does it do? It breaks structure right here, right? So now we have our liquidity sweep, okay? So price filled out all these buy orders, and then we get a break of structure right here. So we have our liquidity sweep, okay? And then we're looking for a retracement confluence, or we're looking for a confirming that price is going to keep going downwards, right? So how do we mark order blocks? Another confluence, right? Order blocks are essentially the candle before the break of structure, or like before the major move downwards or upwards, right? So we can see here that this candle is the candle before price starts to go down, right? Or before price breaks structure, right? So we could see here how I mark order blocks is I go by the opening of the can yeah, of the candle. I know some people do it other ways, but this is how I do it. I just go by the opening of the candle, right? And then what does price do? Okay, price comes back up into our order block, and then what does it do? It goes downwards. And I made money off this. I think, when was this? On Friday. Yeah, I literally did this trade. Um, but yes, so we could see here, price broke liquidity, breaks structure, taps back into our order block zone and our fair value gap, and then it goes back down. So that is what an order block is. All right, so our last confluence, even though I said the other one was the last one, this is our last one for this time. Obviously there's more confluences than the ones that I'm showing right now, but this is just the main ones that I use. There's this thing called like Fibonacci sequences that I don't feel like going over right now. But this these these are the major ones that I use, right? Okay, so the last thing that we have to go over for this time, to like miles. Anyways, is equilibrium, right? So what is an equilibrium? If we were to mark it here, right? So you have this low up to the or this swing low to this swing high. So what we do is we first mark it out, right? And you could see here. Oh, also, if you want to know how to get this, it's gonna look different when you first get it, but you go into this area, you go into this GAN box. It's called a GAN box, right? And then you have to press on it, and then you have to go onto this button that says settings. What I do is I have all of this stuff turned off except for 0 and 0.5. But anyways, so what is this, right? What is it showing us? We can see that price creates, or let's make this, let's add onto this so it's not as confusing. There you go. Okay, so we could see price creates this low, right? Creates a low, it creates a swing low, and then it creates a swing high. So what can we do? We can mark off our equilibrium, to from this low onto this high. Okay, and then what does price do? We could see price taps back into this green line area or underneath our discounted price. That's what it's called. If it's kind of hard to explain, but all you really have to know is that price is going back underneath this green line. And then what does it do once it goes underneath this green line? It goes right back up, right? And that's what it equilibrium is. It's basically it's like again, it's like another fair value gap. Price comes back down into a certain area and then just goes back up. And then same goes if we're in a downtrend, which I'll show right now. Okay, so we have our GAN box market. Anyways, we have our equilibrium, right? So we can make so we know now that we have our swing high and then a swing low. And then what does price do? Oh, actually, let me redo it. We can mark off, now that we have our swing high and low, we can mark it off. We can mark off our equilibrium or our GAN box. And then we could see price taps into our area and then comes back down. Okay, so let's now get an example in the charts of our equilibrium. Right, so as I can see here, or as you can see here, we have this swing low and this swing high, right? So if you were to mark it down, we can do this low, so from here up into that line right there, and then look what price does. You can see price hits or creates this low, goes down into our discounted price, and then comes back up, and we can see price continues in that direction. And then we can get a better example here, or not a better example, a different example, sorry. Right here, if we were to go in a downtrend or we're going bearish, right? So what do? We have our swing high and our swing low right here. So we can mark it off like this. And then what does price do? Right, we can see price comes back down. We create our swing low. And then after creating our thing, our equilibrium, we can see price touches our discounted price zone. And then what does it do? It goes back downwards. So now you're probably just thinking like, okay, what does this matter, right? Confluences are very important in trading as they, again, as I was saying earlier, they basically just show us or kind of confirm to us where price is going to go, right? So in live markets, if I see a fair value gap is created, I'm going to mark off the fair value gap and then just kind of expect, okay, price is going to hit this area and either make an inverse fair value gap and go the opposite direction or hit this area and then bounce back either down or up, right? So what were our confluences? We had our fair value gaps or FVGs. We had our inverse fair value gaps or our IFVGs. We had our order blocks. I just call them OB. And then we had our break of structure or BOS. And then we had our equal equilibrium. So that's just all the main confluences that you have to know, or at least the ones I use. Again, there's obviously more that comes in when trading. There's these things called Fibonacci's, and there's these things called SMT divergences. There's a lot more. But these, oh shoot, I just deleted the text. But these are the main ones that I use, right? The order blocks, the fair value gaps, and all this stuff. I don't really use any other ones. I know SMT divergences and Fibonacci's a lot of people use. I don't use them just because it's kind of confusing. Well, it's not confusing, but like I just don't need to use them. I mean, it would be better if I did, but yeah. So those are the confluences. If you have any questions, just text me. You can just literally just text me on Instagram or text me in the group me or text me in wherever, and I'll most 1000% respond. And again, I know it's still a little bit confusing, but over time, as you spend more time in the market, you'll be able to see it, right? Um, like I've been doing this since summer, and I've been learning about and I've been learning about, it doesn't really take long to understand. Like you guys can kind of already tell like how this works. For rally gap, boom, price hits for rally gap, goes down, right? Um, but yeah, so it's really simple to understand, but it might take a little while to get used to and just kind of understand how price, reacts off of it. Um, So yeah, if you have any questions, just let me know, text me, blah blah blah, and I'll be happy to respond.